Good evening. My name is Bridgette Sudds, and I will be presenting to you a DuPont analysis for the public companies Uber and Lyft. Uber being the main company and Lyft being the major competitor. Before I get into what a DuPont analysis presentation is, let me tell you a personal story. Earlier this year, I actually had to take Uber to get to and from work and to and from school. While I was able to take Uber, it was a good time for me to see how the process worked. I chose Uber over Lyft at the time because of the branding that Uber served, and plus it was partnered up with other major entities. So while taking an Uber, I got a chance to see the different type of vehicle and which caliber that they were on. Now, as far as Lyft, I also got a chance to take Lyft as well. And I was surprised to see that Lyft was similar to Uber as far as the type of vehicles that you were able to choose from. And at that moment, I said, okay, I would prefer Lyft over Uber. But from doing this DuPont analysis, things may change. The purpose of this DuPont analysis is to evaluate the component parts of a company's return on equity. The ratios that I will speak on are liquidity, profitability, leverage, efficiency, and market value. Please note to keep in mind the effects that the COVID-19 pandemic played a role in the decrease in most of the ratios in 2020. Before I dive into the different ratios, let me give you a synopsis of Uber and Lyft. Uber, founded by Travis Kalanick and Garrett Camp, is a car service where an individual can receive a ride at short-term notice. The company was founded in 2009 and is based out of San Francisco, California, and it went public in 2019. The way the service works is that a person will request a car to their current location, from their current location, and once the driver sees their request, the rider will receive GPS updates of the whereabouts of the vehicle that will pick them up. Uber technology system allows for the company to act like a metered tax service. In order to take advantage of this service, the individual would have to download the software onto their mobile device and connect your bank account or payment wallet so their service can be booked and payment can be processed after the service. Or a person could receive a ride service through another person like a friend or family member scheduling the service for them. Lyft, the dominating competitor, also decided to power the movement by looking at ride sharing from a different standpoint. The company thought how transportation affects the economy, social economics, and the environment for the future. They figured that people could create their own network with their own vehicles. Their goal was to take drivers with extra seats in their vehicles and charge for the other seats to take people to their requested destination. This will be better for the environment, and that is when Lyft was born. Founded 3 years after Uber in June 2012, Lyft made a name for itself by focusing on vehicles for hire, bicycling sharing, rental cars, and food delivery. The founders are John Zimmer and Logan Green. Headquarters are based in San Francisco, California. And the company also went public in 2019. Now let's talk ratios. The first ratio I will talk about is the liquidity ratio. This ratio asks the question, does the company have the ability to pay its debt obligation? This ratio focuses on current ratio and quick ratio. As you can see from the formula, the current ratio is current assets over current liabilities. Let's look at Uber and Lyft's financials. Okay, so if we go here, as you can see, I have the tab for Uber financials. Now we want to take a look at the assets, which are the current assets. Which are 9,882, and you're going to divide that over the current liabilities. Okay, and here that number is 6,865. So if you see, we looked at B27 on, now we're taking a look at the Uber financials. The line items were B27, which were the current assets, and then you're going to look at B76, which is the current liability. So you would get 1.4. The same way if we look at the Lyft financials. Okay, same setup. They go our current assets of 2594.138 over our current liabilities, which was 2074.71. And you see the formula is already done for you right there. B19, which is the current assets, B49, which is current liabilities. Now this is for 2020, but if you take a look at 2019, 2018, and 2017, you can see the various ranges, but they're pretty close. You want this number to be greater than 1 because now it shows that that both companies do have the means to pay off their creditors. Okay, now if we want to look at the and with the current ratio, it's a good sign for investors because you want it greater than 1. That means that they can pay their debt obligation. That's what I wanted to say. The quick ratio, on the other hand, is current assets minus the inventory divided by the current liabilities. Now we want to take a look at what inventory is. Inventory in some ways means stock. So right now, if we look at, we have go back to Uber financials, you can see we're looking for B28 over B76. So we see that B28, I did a calculation because we would have to pick up a lot of line items, which would be the inventory. We say current assets minus inventory. So we're looking at cash and cash equivalents. We're looking at accounts receivable, the gross. We're looking at allowance for doubtful accounts, and we're also looking at other receivables. The same with Lyft. Lyft is a little bit different because all financials do not look the same. Some of them don't have the same line items. As I'm doing the research, looking at Uber and looking at Lyft financial statements. But as you can see that both companies, all 4 years, are greater than 1. It shows that both companies can pay its short-term obligations within 1 year. Let's move on. Now that we're done that, let's move on to the efficiency ratio. Okay, now the efficiency ratio is going to ask the question, how profitable is your company? The ratios you're going to look at, we're going to evaluate are trade receivable turnover, trade payable turnover, and asset turnover. With trade receivable days, the shorter the ratio, the more attractive to the investor. This means that the company collects its debts quickly. Uber shows in 2020 a smaller percentage of 7 versus in prior years having an average of 8.3. Let's look at trade payable days. This ratio shows how long it takes the company to pay its vendors or creditors. An investor would like to see this ratio greater than the receivable because it may show that the company is holding on to funds, which could be beneficial if it's in a bank account collecting interest. In evaluating Uber and Lyft, the ratios show its average from 2017 to 2020 of about 62 times over that is capable of paying off its debts. Asset turnover is the ratio that measures how the company generates funding. With this ratio, the number needs to be higher because it shows that the company is efficient in generating sales and revenue. For Uber, the term sales will be the service that the company provides, ride sharing. In evaluating Uber and Lyft, the ratio shows Lyft over Uber being able to generate more sales from 2017 to 2020. Now we're going to go back to the spreadsheet. So as you see with the spreadsheet, okay, we're talking about asset turnover. Wait. With having knowledge of this information, an investor can conclude that even though Uber has shown to have partners with many of its entities, the companies can be shown to be spread thin. Now we're going to move on to profitability ratios. So profitability ratios ask the question, how efficiently Uber and Lyft generate profit and value for shareholders. The ratios to look at are total profit margin, EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. That margin, return on total assets, and return on equity. Total profit margin is a straightforward calculation, which is revenue minus expenses divided by revenue. This tells the investor how flexible the company is with revenue. The lower the percentage is, it tells the investor that it's less flexible. You would need for the percentage to be higher in case you need more funding for things such as marketing and other company resources. Another ratio will be return on equity. The return on equity ratio looks at the bottom line of the net profit of the income statement and the liability side of the balance sheet. From research, the ROE, return on equity, should equal and be above the industry standard. The ROE for Uber and Lyft shows various range. This can be from numerous factors like stock performance. The next ratio we're going to look at is the leverage ratio. This asks the question of how much capital comes from debt. It consists of the debt ratio and time interest earned ratio. Leverage is also important if you want to sell off shares or debt. Both Uber and Lyft's debt ratio isn't greater than 1, meaning that its assets is funded by equity. Time interest earned looks at the company's current income and measures to see if the company pays its debt. In order to continue to invest in the business, the time interest earned ratio needs to improve year after year. So let's go back and look at that. So with our time interest, we're looking at our Uber financials. So we're looking at B128 and B130. Okay, so B128. So this is going to be our revenue. And we're going to take out this is where it comes into, we talk about our earnings before interest, taxes, depreciating, and amortization. And as you can see, I also did a line item for the calculation of the time interest earned. So you're going to have their revenue, and it's going to take out all of those that I mentioned earlier, okay, and divided by, it's going to be divided by your interest expense, and then you're going to see. Now, you want that number to improve, but like I say, 2020 was a year that both Uber and Lyft suffered because the whole United States was shut down. Now, the performance of Lyft, looking from 2017 to 2019, didn't really do well. You see, we don't even have any numbers. Now, the last ratio I'm going to speak on is going to talk about the market to value ratio. Now, this analysis, in October of this year, the share price for Uber was $41.88 a share, and for Lyft, $44.73 a share. We look at price earnings ratio and market value to book value. An investor will want to see if the stock price were overpriced or underpriced. It also shows how well the company has performed, and from this information, the investor can see future expectations of the company. If the ratio is low, that will confirm that the company has limited growth opportunities and probably should return equity to investors. Now let's look at this spreadsheet. Let's go back and look at, we're gonna look at the price earnings. Now this is in October. So what we wanna do is we take the price earnings, and if we go back to the Uber financial statement, we're gonna look at the net earnings, the loss per share, the basics, which was a negative 3.86. Now, as you know, as you see, all of these numbers are in the negative, 2020 being the greater. We lost a lot in shares. Lyft, on the other hand, was 44.73. And so you see that number is greater as well in 2020, and it was because of what the market. Now the book value to market value, let's look at Uber financials. Okay. Now, this will look at the total liabilities, the redeemable non-controlling interest, and you're going to see we're looking at over 163, which should be the year-end shares outstanding, and that gives you 6.63. Lyft, same calculation, it gives you 5.18. And that's all for your market value to book value. Now, in conclusion, while this analysis can be helpful to the investor and the consumer, it can also become a tool for the officers and managing partners of both Uber and Lyft. The ratio calculations will show and prove the highs and lows of the companies, especially the 2020 year due to the COVID-19 pandemic. As indicated in the abstract, what the purpose of this report is highlighted for is to highlight for Uber. I hope you were able to answer two questions. How long will the company Uber be able to sustain? From the two, which company is better to invest in as an investor and a consumer? On a personal note, as a consumer, I choose Uber, number one, for the use of marketing research that it spends for, and looking at the cash flow statement, and also the share price is lower than Lyft. Thank you.